Welcome, 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 everyone, to the 2022 Business Summit hosted by the Peterborough and Kawarthas Chamber of Commerce in partnership with Peterborough and the Kawarthas Economic Development. We are honored again this year to bring you the Business Summit. Everything has been recorded that was live. We also have a variety of pre-recorded content that you can access at any time. pkchamber.ca, just click on the Business Summit button. You'll get dedicated to the page and you can take advantage of everything that we've been doing all week long. So thank you everyone for joining us today. Of course, like I just said, today's session is being recorded. So if there's someone that had to miss out on today, someone you think should see this presentation, you can go ahead and send them the presentation after the fact. You can direct them toward the Business Summit webpage. So please take a moment, shout out our sponsors. Of course, our sponsors make the Business Summit happen every year, fuels us to do the work, and we are grateful. A big shout out to Business Development Bank of Canada, BDC, our summit sponsor, our profile sponsor, Nexicom, and of course our knowledge sponsors, Microwage, Peterborough Whitby, and Linwood Croft Royal LePage Frank Real Estate. Follow them on social media, check out their content. They're always sharing really helpful information. So big shout out to them today. Thank you for joining us, everyone, for succession planning. What happens if? We are honored today with Rhonda O'Flynn Brophy of IG Wealth Management. She's going to walk us through succession planning tips and tricks information. So first of all, before I read you her bio, Rhonda, thank you so much for joining us today.
Thank you so much, Tiffany. I'm honored, and thank you for this opportunity to be able to present this live workshop.
Such a pleasure. Your experience is vast. Of course, we've posted her whole bio on the webpage. You have to check it out. But a good snapshot before I jump in is while Rhonda's giving her presentation, we will have a dedicated Q&A portion at the end of the presentation. So feel free to unmute yourself, ask a question, raise your hand, drop it in the chat. You can even message it to me directly. So that being said, Rhonda, our speaker, is qualified as a CPA with the Institute of Certified Public Accountants in Ireland in 2003. She further achieved first-class honors degree in applied accounting, an A-certified tax advisor designation, and recently an EMBA with the Quantic School of Business and Technology. Rhonda holds in-depth experience across various industries and sectors, significant operations and financial management experience, coupled with a very broad knowledge of European and North American business markets from both commercial and technical perspectives. Rhonda, thank you so much for joining us today. I'm going to turn it right over to you.
Well, thank you so much for that introduction, Tiffany. So my introduction slide about me has already been done by Tiffany, so thank you again about that. Just a couple of things. I will just tell you about IG and myself. I partnered with IG in December 2021 after selling my own accountancy practice in 2019. The reason I did that is because I want to be able to give back to Canadian people and businesses by being able to help them with their future financial planning and ensure that in their retirement that they are successful. So just a little bit about IG and why I joined them. Like, they inspire confidence for over 90 years with Canadian families. They have been trusted for generations. They have over 2,000 advisor practices right across Canada, and their proprietary IG Living Plan is a sophisticated, interactive financial planning experience that we offer business owners and individuals alike. You don't have to be a $50 or a $500 or a $500,000 person. You can be just a normal person having an individual financial advisor at your disposal. Now, IG have 103.3 billion assets under administration. That's phenomenal. And they have access to world-leading asset management expertise and exclusive management investment solutions. As you can see, we partner with BlackRock, JP Morgan, all the big names, McKinsey, Aristotle. They're uniquely positioned in the Canadian marketplace and part of the Power Corporation of Canada. As you can see, IGM Financial has umbrellas under the wealth management, private wealth management, investment planning and control, along with the Canada Life, Personal Capital, Pangora. We partner with world-class partners like Aristotle, BlackRock, Northleaf, all the names that everybody is affiliated with regarding investments. insurance with Canada Life, Manulife Financial, Sun Life and RBC, and Equitable and National Banking. So basically, our advice leads to better financial outcomes and opportunities for business owners and individuals alike. Is like a difference in household financial assets attributable to financial advice. If you have no advice, you're not going to go anywhere. You're not going to invest in assets. You're not going to excel. Whereas if you have a financial advisor partnering with you through all of the stages of your life, like they say, it's about 2.3 times that you will invest and evaluate and project your own financial analysis to scale yourself better for retirement in your future. So why do we have a synchronized holistic financial plan? It's never been more important in your life. You need to be able to manage your cash flow efficiently, prepare for unexpected events, plan for major events, maximize your business, plan for your retirement, and share your wealth. All of these tax efficient strategies are for your financial well-being. So what is IG's commitment to you? Well, we focus on you by managing and helping your financial plan and investments, focus on your goals and your financial strategy. We provide confidence because your success is our ultimate goal. We provide clear financial guidance. This helps you gain greater visibility and control. We keep you informed. Our fees are transparent. We provide you with ongoing updates, and we will track your overall progress towards your goals. And though our approach is sophisticated, the way we explain it is not. You can expect excellent and ongoing service on many, many levels. And IG, well, we're committed to the community. Our people invest their time, skills, and passion in making our community the very best now and for the future. So getting to today's live workshop, succession planning for business owners. And I am going to talk about planning to retire and how you will plan your exit strategy. We need to consider the 3 S's, which are succession, selling, and shutdown. I'll also discuss how you navigate your business life cycle and then how to prepare your business for sale. So step 1, you're planning to retire. You need to plan your exit strategy. Planning in advance is the key to a successful sale. You want to get the best price for your business. You need to ask yourself, why are you selling? Who are you selling to? What do you want out of the sale? And then you need to find the right buyer to preserve your business legacy that you've worked so hard over many years to build. So selling a business can take a lot longer than expected, and inadequate planning processes will end up leaving money on the table. Like some owners need to sell in a hurry due to health or other issues, but aren't ready. So it leaves them exposed to receiving less value for their business because they're selling in a hurry. Statistics by BDC study, according to their study in 2017, 2 in 5 Canadian business owners will think about selling their business and not buying a new one. The main reason being retirement. And nearly 60% of small and mid-sized business owners are aged 50 and over. Other stats from BDC in a survey in 2021 realized that within the next 5 years, 9% of entrepreneurs in Canada expect to sell their business to people outside of family and management. So a significant number of entrepreneurs are thinking about retiring and selling their businesses. And with so many sellers on the market, the competition could be fierce, especially for those who haven't taken the right steps to actually prepare for the sale of their business. They leave money on the table. Why? By not being prepared. It's much like a homeowner putting a house up for sale. Any entrepreneur planning to sell a business, which is typically his or her biggest asset, wants to realize the highest possible return. So as for a house sale, careful preparation must be made for your business sale. So what are the factors that affect the sale of your business? Well, lack of tracking financial performance, improper bookkeeping and record keeping, or business owners not leaving enough cash in the business. So from a buyer's perspective, a business that can show a healthy cash flow, is well maintained, enjoys sustainable growth, is far much more an attractive business to buy. So the 3 S's, the selling, the shutdown, and of course the succession. So 3 options for succession. 1, sell to a family member. 2, an inside buyer or a management buyout. Or 3, an outside buyer, completely independent third party. And then selling considerations or just possible shutdown. So succession and selling to a family member. So the primary owners of Canadian business are baby boomers, and many preparing to retire in coming years, and 40% of them expected to transfer to the business to a family member. So even though your children might be young or studying, succession planning is not a process, but an event that requires months, if not years, of preparation. So what should be on your to-do list? Well, you need to contact your bank and advisors to inform them of your intention to sell. Liaising with your accountant, tax advisors, and your financial planning advisor is key to the success of a good sale. But how do you start the conversation with your children on taking over this family business? Family business succession can bring out underlying conflict, so maybe to engage the services of an advisor or a mediator to help manage expectations and minimize tensions between family members would be advisable. But are you ready for your children to take over the family business? What if they actually don't share your vision of the company? What do they want to achieve? And can you help support their vision? Or what if they don't really want to take over and they want to take a different career path? These are all things you have to consider, especially when you're thinking of selling to family. You have to make sure as well that the sale price is for a fair market value, even if you're selling to your child. And also, crucially, to respect the new family CEO, as the new boss is not the old boss. So what are the advantages of selling to family? Well, your family benefits from your business legacy and is likely to preserve it and retain your existing employees. It's a win-win situation. The transition will be smoother than from an outside sale, increasing the likelihood of repayment for vendor financing. You, as the seller selling to your family, may have to help finance the sale. But the disadvantages, as always, this may not lead to as high a sale price as selling to an outsider, and it is more likely going to require you financing the sale. And family tensions could arise if someone feels unfairly left out of this business. So again, another one, to minimize the tax hit of selling to family, you start early. Plan in advance with your tax advisor to avoid a large bill. Minimize the capital gains tax, because tax is on half of the gain at the marginal rate of tax, which is usually the higher rate. An exemption for a transfer to spouse is allowed, and a lifetime capital gains exemption can be claimed if a business qualifies for a small business corporation. This is closing up to 913,630. So per Canadian. So even if you plan in advance, you can give some shares to your children. You will have multiple lifetime capital gains exemptions if you have more than one person holding the shares of the company. You could consider an estate freeze, which is lock in the gain and the capital gains tax by exchanging your common shares for a fixed value preferred share and then issuing the common shares to your children. The future growth in these companies' value goes to the common shares and isn't taxed until your children actually in turn sell or gift their shares. And the shares can be held by the children directly or in trust. And again, these tax, exemptions should be discussed in full with your tax advisor way in advance of the exit strategy to sell. And then finally, if you haven't already incorporated and you're a sole proprietor, incorporate, because owners of an unincorporated business do not qualify for the lifetime capital gains exemption. And generally, they can't do an estate freeze either. So just basically the tax benefits of incorporation in summary. Capital gains of up to 913,630, tax-free on the sale of a qualifying business corporation. And to qualify as a qualifying business corporation, at the time of sale, 90% of the value of assets used to earn income must come from active business. And in 2 years prior to the sale, 50% of the value of assets used to earn income must be from active business. And as I already discussed, you can multiply the capital gains exemption when family members actually own the shares. So if you're selling your corporation for 3 or 4 million and you have 4 people owning shares, you will have 4 times 13,630 tax-free. Really something to consider and plan prior to your exit strategy. So succession number 2 would be an inside buyer, which is actually a management buyout. Finding the right people in your company to buy out your company, the right shareholders who actually share your value and vision. You need to be able to transfer the knowledge and responsibilities to these people, and this can take years to implement. You also need to negotiate a price between the buyers and the sellers. The buyers being your management buyout team, your seller being yourself. It's advisable to get a business valuation from an external third party, even if you have negotiated a price, just to be sure that you're getting a fair market value price for your business. And then to finance the MBO, well, then you may, as the seller, may have to go to your bank and discuss options to finance the MBO with your management buyout team. Some of these could be shares sold to the employees, an asset valuation on the collateral assets of the business. The seller, you yourself, may allow a staged buyout plan over a number of years, so to allow the cash flow of the business grow, or else the buyer will just get the finance from an independent financial institution themselves. So there's plenty of ways of financing an MBO. So the advantages of a management buyout. So as managers or employees, the new owners are already familiar with the company. Purchased by insiders are more likely to result in a smooth transition. Your business legacy will remain intact. Employees get to keep their jobs. Financing is usually easier to secure because of better chances of a smooth transition. But again, as with a family buyout, it may result in a lower sale price than selling to an outside buyer, and it's more likely to seek vendor financing. Finally, an outside buyer or selling to a third party. Again, you must start planning early, at least 2 years in advance of the exit. You must ensure the type of transition you choose is aligned with your retirement strategies. So the options for a business owner looking to sell: through an IPO, which is an initial public offering. That would be the sale or the issue of shares in your private company on a public stock exchange. The second would be to private equity, the sale or issue to shares to a financial investor. Or finally, sale to another business. The sale or issue of shares to another operating company, similar probably to the industry that you are operating in. It is a good option for shareholders looking for a clean exit and to maintain the highest possible value. So the advantage of this type of buyout is it's more likely to get the highest sale price, and it's less likely for you as the seller to seek vendor financing. The disadvantages are, though, that your legacy may be affected. Employees may not be retained. The business is significantly altered post-sale, and the transition may not be as smooth, which can lead to delays in vendor note repayment. A lot more due diligence would have to take effect with an outside third-party buyer, as they don't know the business and they're not in your financial status of knowing how your business is operating. Now, a mix between any of the above options is also feasible. For example, you could sell to a management team that includes your children and employees. So let's look at the considerations of selling. Outside sales can be more turbulent than other choices, because if you're concerned about the legacy or longevity of the business, you should take the time to find a buyer whose values align with your own. Consider hiring a firm to look for buyers, as you will need to help to compile an information package to share with potential buyers on the background of the company, the valuation, the financials, employees, and the structure. The next step would be to perform a due diligence with a prospective buyer, which can be distracting and time-consuming. So make sure you are prepared for the process and assign people to deal with each stage, as in share the load. Deals often fall apart during due diligence, so be prepared is crucial for a successful sale. And as the seller, you need to decide what type of transition you want to have with the outside buyer. Do you want to exit completely, or will you offer to stay on for a period of time on a contract basis, as in a phased transition? So shutting down your business. But some business owners think that this is their only option, believing that their businesses have no saleable value, which can be quite untrue. Intangible assets such as intellectual property or client lists should not be overlooked. They have a value attached to them. It is important to get a professional opinion on the value of the business prior to your decision to cease. So how would you increase the value of your business? Your advisor can offer recommendations on how to improve your valuation. Trust in your accountant, your tax advisors, your financial planning advisor, and your lawyers, and start early so you have time to implement these and raise the value before you sell. If selling your business is part of your retirement plan, there are ways you can increase the value to get the best price. And the earlier you plan these steps, ideally at least 5 years before the retirement, the greater the result you achieve. So again, key planning in advance. So let's just quickly navigate through each stage of the business life cycle. So on a startup, the main factors that you should consider are managing your business cash flow, protecting your income and your family's well-being, minimize your exposure to liability claims from suppliers or external factors, know when to incorporate, and ensure that there are insurance solutions for business to protect your business. In the growth and expansion phase, consider a shareholder and partnership agreement. A shareholder agreement is when you incorporate it to a company. A partnership is maybe if you have a limited liability partnership with another person. Implement group health, dental, and drug plans. Ensure that you have business overhead insurance and especially key person insurance, so that if you lack a key person or they get sick or disabled, that you have key person insurance available so that it doesn't affect the growth and expansion of your business. On the maturity side, liaise with your accountant to make sure that the structure and the appropriate use of holding companies and trusts is implemented as you mature. Ensure the tax efficient allocation of investments. Consider individual pension plans for yourself and key members of your shareholder team, and ensure that permanent life insurance has a cash value at the end of it. Finally, in your succession or transition stage of your business cycle, advice on structuring the sale is key, again, with your advisors, your accountant, your lawyer, your tax advisor, your financial planner. Make sure tax efficient investing and drawdown strategies, life annuities, and permanent insurance and charitable giving strategies are implemented. So finally, what increases the value of your business? What makes a business more attractive to an outside buyer? And what makes a share sale more likely? Well, knowledge of your potential buyers, a recurring revenue within your business, make sure that your revenue is recurring, is very attractive to a buyer. Diversity of client and supplier relationships, not just having one supplier and one client. You need to be diverse in all of these relationships. Ensure clarity of your financial statements. Usually in financial statements, there's a lot of muddy transactions between shareholders and owners, and it gets clouded with what the visibility is between what is a company asset and what's actually related to the owners and shareholders. These need to be tidied up well in advance of sale. A management succession plan. Are you actually gearing your management and your team and your employees so that you can exit strategy without needing to be there? This is very, very lucrative to a new buyer coming in or a purchaser. And then of course, visibility. Oh, I beg your pardon. I didn't mean to do that. The visibility within the community will ensure that your business will sell and you will get unsolicited offers. So basically, in summary, how to prepare your business for sale. Number one, clarify your options. Decide whether you're going to have an internal buyer, the family or the management buyout, or a mix of both, or an external buyer, which is a third party. Two, prepare your successor. For a family, it's usually anywhere up to 5 years, and an external buyer, normally 1 to 2 years. Three, prepare your company and business. Take advice from your advisors, financial planning advisor, accountant, tax, and lawyer. Ensure your financials are healthy to maximize your sale value. Remove personal items from books and records. No officer loan accounts or muddy transactions. Visibility is crucial to a prospective buyer. and incorporate to avail of the capital gains exemption. And then for financing, you must engage with your bankers to insist that the finance for the transition goes smoothly. So that's it. This is our team. We're strategic, we're client-centric, and we are ready to help. And thank you from me. My name is Rhonda O'Flynn Brophy, and I'm at IG, and you can get my details from this slide. Thank you.
Excellent. Thank you so much, Rhonda, for walking us through that. Of course, I've got a little page of notes. I was just kind of scribbling some things down.
That's okay.
We had a couple of questions kind of come in the chat, so I'm just going to walk us through those. Some really great questions here. So the first one that came in was, when should a business owner start to plan their exit strategies? What are some red flags, or what are some kind of signs that they need to start getting that into motion?
Well, that's a very good question. I'll tell you why. When is a very good time to do anything? When you think you're going to, a lot of business owners think they're going to live forever. They really do. They love their business. They're in their business. They operate their business. They've started the business. They've built the business. They are the business. So they find it very hard to actually step back and go, oh my God, I want to sell this business so that I can retire. But, ideally, you should be planning to sell your business the day you start it. So when you start your business, you should already be looking towards your future. So if you're starting your business at whatever age in life, 20, 25, 30, 35, have your plan in place as to what your exit strategy is going to be. So it really doesn't matter. My point is, when you start a business is when you should be thinking about your exit strategy.
Excellent, excellent advice. I'll never forget once one of the careers I was working in, we were in the lunchroom having a conversation with all three owners, and all three owners were going on a trip together, a conference, and it all dawned on them. They were all traveling in the same plane, in the same vehicle, and they realized they did not have a succession plan in place. So it was almost like the scramble leading up to them going on holiday.
Yeah.
Right?
Lastminute.com just does not work.
No, so excellent. Good perspective, good advice there. Highly recommend you take that. Start today, even if it's just one small action into that direction, right? So next question we had was, what is the difference between succession planning and replacement hiring?
Well, succession planning is, as it says, succession. You're exiting the business through one form of strategy or another. So replacement is actually replacing somebody else, and you're still in the business. So you could, for example, hire a CEO or a CFO, and you're just still there on the helm. You're not actually exiting your business. So you could get a team of a board of directors, a CEO, a chairperson, a CFO, a COO. You have a hierarchy management structure. So you might be expanding your business and going to the next echelon, but you don't want to actually exit. So you're replacing yourself with a team of people who can actually grow the business further. You might end up selling it to an IPO on the public Toronto Stock Exchange. A lot of Canadian corporations have actually started off as a family business, and they've maybe sold part of their business as part of an IPO and kept it. And then eventually it dilutes itself out. It's a bit like the House of Gucci, where they first started with Gucci. And then all of a sudden, even though the Gucci name is Gucci, they're not Gucci. There's nobody belonging to Gucci left in Gucci.
Great example. That is a really great example. A couple more that we had coming in. I've got, what is the most common mistake people make when selling their business? What have you seen as the most common mistake?
Not planning. Sorry, you gone?
Nope. Yeah, the lack of planning.
The lack of planning. Sorry, I didn't see anybody there. My mic. There we go. So lack of planning. Again, it's like, I don't know, I think if I said it once, I said it about 10 times over my slides. Plan early. Start early. Like even, I can't stress it enough. It is the biggest factor in an unsuccessful sale. You will not get the value of your business if you don't plan early. Things happen in life. Life events happen. Personal events happen. You could go out, get knocked down by a bus and be disabled, and you have no plan in place to mitigate what's happened to you in this life event. So now you're stuck in, okay, I don't have any children. Okay, now I don't even have a prospective buyer because I'm actually not able. Now you will have to rely on probably your accountant, your tax advisor, your lawyer, which is going to run into huge costs because you haven't planned with them all along the years. The thing is to grow with your advisors. Have them with you every stage of your business life cycle. Every stage of your business life cycle, you should be protecting your business and making sure that your plan for succession or transition is going to work 100%, that you're going to get the best value for your business no matter what, and never leave it until it's too late or something or a major life event has happened. Always be one step ahead of life events if you can.
Thank you. Really great question. She got passion, pulled the passion out of her. It's interesting because we plan for our retirement like our whole lives, you know,
Exactly.
that same behavior should happen when we start our businesses too, is have that hat on.
You have to treat your business like your child. Nurture them in their stages of growth so that when they're ready to fly, everything is perfect.
They've got the tools. That's right.
Exactly.
Another one came in for us here. How do I communicate my succession plan to employees?
It depends on the succession plan. If you are planning to have a management buyout with your employees and your co-shareholders or your management team, it could be your manager who's managing your business, well, then you just sit and have the discussion to say, it's time for me to exit. I want to retire. I'd like to sit with you if you would like to have a management buyout. Normally, as a management buyout and you're selling, you're going to have to help them finance the sale, but you get to be in the driver's seat. You get to know and see where your legacy ends up. You also will have a commitment and an honorability and a loyalty to the people who have helped you grow your business to get to this stage for your retirement. So to give them and offer them the opportunity to actually buy out the business that you have built is just the most wonderful thing you can do. Now, it doesn't always happen because sometimes the financing can't be, or sometimes they just don't want it. Maybe they don't want to take, ownership of such a huge responsibility, because it is a huge responsibility owning and managing and operating a business and keeping it going and growing it for further expansion and for somebody else to be able to do a rollover management buyout. Also with employees, you can engage with your own children and offer with them and do a joint management buyout with your family. That keeps everybody happy. But with an outside buyer, well, that's different. You need to go to the likes of your accountant and put together a financial pack. You need to put together all of the information that's going to make it extremely attractive for an outside buyer to buy your business. And as I said, clarity of your financial statements, visibility in the area, if you're a well-known business like Kawartha Lakes Construction, some other big Toronto builder like the Daniels Corporation are going to look at, say, maybe buying into that because they want to get the catchment area in the area of Peterborough. So, they will want to have a look at the complete package and how their performance is, what their employees are like, what their financials are like, what their growth rate is like, all of those major factors. So it's different for every succession, whether you're family, management buyout, or independent buyer.
There's lots of options, and luckily professionals that we can lean on for the information, for the right direction. One of the things that came up too was, is there a way to measure how well a succession planning is working, or how solid your succession plan is?
Well, now this is not, I don't want to be like selling IG or any financial advisor, but to have your financial planning advisor doing an overall holistic plan, it's like your own personal plan, whether you want to have investments, whether you want to have insurance solutions, helping you with your mortgage solutions. It's the same for a business. You need to allow your business have access to all of those advices. And a business is a separate legal entity to an actual person. So it's nearly like they're a person, but they're like needing you as their owner to guide them through this process. So you need to allow your business access to all of the financial advices, all of the accounting advices, all of the tax advices, all of the legal advices, all through its stages. So if you do that all through the stages of your life cycle, then you're on track to making your business completely successful. If you only decide to do all of these measures 3 months before you decide an exit strategy, it's game over. It ain't going to happen. It's not going to happen. With all the will in the world, it's not going to happen, because when you have independent advisors, they are independent advisors. So they need to get together collectively as a unit and be able to trash out due diligence or trash out legalities, or, put an evaluation on your business. That itself takes time. And it just doesn't happen within 2 to 3 months. They're going to need to work with you as your business grows. And, definitely during the growth and expansion stage, whatever about the startup stage of your business, but in growth and expansion, you have to have your team of advisors on board all the way through.
Again, comes down to that planning, right?
Yeah,
and it's never too late to start. Just go, unless you're 3 months out, then it's too late. But
yeah,
otherwise,
absolutely, for sure. Yeah.
Otherwise, for sure. Now, Rhonda, have you seen, how has this pandemic affected exit strategies? Are you seeing business owners maybe changing course, delaying, or speeding up the shutdown process instead of selling? What have you been kind of seeing there?
A lot of people have had to pivot. It depends again on the industry sector. For example, an accountant practice like what I had, everything could be done virtually. Employees can work from home. You can meet your clients on Zoom or Microsoft Teams. Okay, the interaction is different, but at the end of the day, the overall result giving to a client is the same as if you met them in person. So from that perspective, an accountant's practice wouldn't actually be hindered in the sale or succession planning, because the factors of the pandemic, all they've done is number one, they've stopped people meeting each other except on virtual, but it hasn't actually stopped the flow of business. However, the accountant could have a lot of retail clients who've had to close down their business during COVID, and all they're getting are government supports just to keep them ticking over. So now they don't have enough money to pay their accountant, which is going to impact the accountant's practice and his fees. So the saleable end of that might be that his practice might have taken a hit to the percentage of maybe 25% if he holds fast-moving consumer goods as in a retail environment on as part of his fee basis. So it does have a domino effect. And again, you have to take it in isolation. But people do have to try and pivot. A lot of retailers went online and did e-commerce and sold direct. Again, it's about thinking outside the box, breaking boundaries, disrupting norms, challenging the way you do your own business, looking for other solutions. At the end of the day, there's always a different way of doing things. There's never one way of doing anything. There's always some other way to do everything. So you just have to think of that way. And as an entrepreneur and business owner, and if you have the drive to make your business succeed, you will also have the drive to know how to pivot your business. Now, unfortunately, some of them have had the impact of maybe leasing business units. And that has had an impact then on the landlord, who now doesn't get the rent because the person that's in it can't open their business for business. Could be a coffee shop. You can't do a coffee shop virtually. So again, you know, there are going to be the pitfalls of COVID and the pandemic. But the thing is, you can open up after. Don't always think that, okay, my business failed during COVID. Why did your business fail? Some barriers just cannot be overcome. They just cannot be overcome. You're never going to sell coffee to someone if you can't open your coffee shop, unless you can open it up through a little hatch in the window. Be reinventive and reinvent the way you sell your coffee. You know, so there's many, many things. And this is why I say to business owners, please don't just pull the shutters on your business without talking to an advisor first. Get a second opinion. You might not have all the answers, but I mean, I don't profess to know the answers to everything, but I know people who do know the answers. So if I want something that a tax consultant can give me, I will go to my buddy in the tax and say, listen, Lyle, I want your advice on X, Y, and Z. And then I will come back to you, Tiffany, and say, this is the answer. You know, but I will get you the answer one way or the other. It's knowing where to look for answers and how to pivot your business. So again, and a lot of business owners are feeling, oh, I don't have enough money for an accountant, or I don't have enough money for a tax consultant. Just ask first. Never, because a lot of accountants and tax consultants and advisors during the pandemic have actually given advices to their business owners, FOC, free of charge, pro bono, whatever way you want to look at it, because they paid them during the good times and they will pay them during the bad times, and they will look after them. And then when the times get good again, they'll pay them again. It goes in swings and roundabouts. So always ask before you actually decide to shut your business down. That's my advice to anybody.
That's remarkable advice. I always ask, lean on your network, ask the questions. It's always good to put it out there. I've got two more questions that have come in. This one is, some types of businesses are easier to sell than others. Many local retailers start out hoping to sell their business, but end up just selling off their inventory. What are some tips to avoid that situation and set your retail store up for a successful sale?
Again, it depends on the actual retail store and what they're selling, because, you know, some things can be niche markets and it doesn't have an awful lot of buyers. So my advice to somebody like that is to sell to somebody they actually are working with, because they know the ins and outs of the business. This could be like a bespoke kind of like, I don't know, craft making a specific beer or something like that, or, you know, winemaking or whatever, and it's bespoke to that specific business. So if it's a good business and it's generating good income, maybe they don't have enough people with the expertise to run that business. So the only people they really can sell to would be the people that work with them. And that's not a bad option, because it's a niche market, or a bit like that CBD now with the cannabis trade. I mean, not everybody knows anything about cannabis. Like, I mean, you know, so you're going to have to sell to somebody who does know. And you may have to manage this buyout. So another advice I would have is to have an excellent working relationship with your banker, because that will be key to the success of you selling a business like that, is your bank relationship.
So just nuggets of gold throughout this whole talk you've been giving. These questions are great because they're just pulling out amazing tidbits from you. So last question I've had come in is, what are your thoughts, Rhonda, on trying to sell a business that shares your name? Is it best to rebrand and risk losing some public profile, or stick with the name and leave it up to the new buyer to rebrand as they like? Well,
I think if your brand is well known in the community, keep the brand. That's a goodwill in itself, and that's an extremely valuable part of your intellectual property. So if you decided to change the brand, you may lose your, customer base. It's a bit like, again, I'll go back to Gucci. If the people who bought into Gucci because they bought into the design, they bought into the brand, they bought into the well-being in the marketplace, they bought into the show of it. So, the brand is part of the business. It could be the biggest part of the business, as was in Gucci, because the people that ended up taking over them were completely independent buyers. And to this day, that brand is still there. And it's no member of the Gucci clan or family are working there. It's completely just Gucci. And it was a family name from years ago. The House of Gucci is actually on, I don't know whether it's on Apple TV or something. And I'd advise anybody to watch it, really, if they're thinking of selling their brand name or getting rid of their brand name before they sell. No, none of it's in the marketplace and well known. Then definitely not.
Excellent, excellent answer, excellent advice today. Again, if you missed today's session, if you know someone that would benefit from this information, this session has been recorded. It will be on our dedicated Business Summit webpage and also on our YouTube channel. Rhonda, you are brilliant. Thank you so much for passionately sharing the information that you know to help business owners move forward successfully. We truly, truly appreciate your expertise and your time today. So thank you.
Well, thank you very much, Tiffany. And again, anybody that wants to reach out to me, I assume you'll put my credentials and my contact details on the website, and you just reach out to me anytime for advice. I'd be happy to help.
Definitely. If you want a warm connection, reach out to me. I'll email you and Rhonda, get you warmly connected. Absolutely. So again, thank you. Thank you everyone for joining us today. Really great questions today too. Really pulled out some great answers. So big shout out to our summit sponsors, BDC, Business Development Bank of Canada. It was kind of great that Rhonda was pulling out BDC stats in her presentation. I thought was a beautiful nod to the Business Development Bank of Canada. Big shout out to profile sponsor Nexicom. You should check out their pre-recorded interview. They were talking about internet and some things coming down the pipeline. A really great conversation with Nexicom. And our knowledge sponsors, Microwage Peterborough Whitby and Linwood Croft Royal LePage Frank Real Estate. Thank you everyone for joining us today. Follow, tag PTBO Chamber and Peterborough and the Kawarthas Economic Development on social media channels. And tomorrow is the last day of the summit. So join us for closing remarks at 10 a.m. And also our final workshop on sustainability in business with Green Economy Hub and Swell Made Co. So check it out. Again, everything's been recorded. Watch the Business Summit page, pkchamber.ca, click the Business Summit. Thank you for joining us today. Thank you to our partners, Peterborough and the Kawarthas Economic Development. Have a wonderful day, everyone. Stay safe. We'll see you soon.
Thank you, Tiffany.
Thank you, Rhonda.
Bye-bye.